In Omaha, Nebraska, there is a company worth over $1 trillion. It owns 387,800 employees. It pulls in $411 billion in annual revenue, and its corporate headquarters has exactly 25 people working in it. 25, not 25,000, not 2,500. 25 people running a $1 trillion empire. The CEO's most famous operational decision, according to documented accounts of his management style, happens once a year. On January 1st, he asks for the candy company's price sheet. He scratches out the old prices, writes in higher ones, hands it back. That's it. That's the year of micromanagement for one of his largest subsidiaries. Now, the internet has a story about businesses that run themselves. It's the dropshipping course, the affiliate funnel, the 4-hour work week, the guy on a beach with a laptop. Almost none of it is real. What those gurus call passive income is just a highly leveraged job. The moment they stop tweaking ad spend, the whole thing collapses. But the thing in Omaha is real. So is the retailer selling $275 billion of merchandise a year, while stocking roughly 4,000 products. So is the software company that has quietly acquired hundreds of businesses and built a $38 billion empire with founders who barely intervene in any of them. These companies run themselves. Actually, run themselves. And the reason is not automation. It's not software. It's not AI. It's a specific structural decision almost no founder ever makes. In the next 12 minutes, I'm going to show you exactly what that decision is. We'll dissect 3 real companies that operate at massive scale with almost no top-down intervention. We'll talk about the 4 archetypes of self-operating businesses, the 8 structural principles that make them work, and the brutal reality that hides beneath the word passive. By the end, you'll see why most people who claim to own a business actually just own a high-paying job, and why the handful who escape that trap built something architecturally different from day one. Let's start with the definitional problem. When someone online talks about a business that runs itself, they usually mean an automated small business, a Shopify store with Facebook ads, a course funnel, an affiliate site. Those are not self-operating. They're tethered to the founder's daily attention. Stop optimizing the ads for a week and the revenue drops. Stop updating the content and the algorithm forgets you. That's a job with better hours. A genuinely self-operating company is different in kind. It's built on organizational design, decentralized governance, professional management, and capital allocation. The system is the product. The founder is optional. Here's what's interesting. There are really only 4 archetypes of these companies. The first is the cash flow fortress, a decentralized holding company that acquires wholly owned subsidiaries and keeps them operationally independent. The parent acts as an internal bank. Berkshire Hathaway is the canonical example, trading at over $1 trillion as of April 2026. The subsidiary CEOs run their businesses. The parent allocates the cash. That's the model. The second is the platform with network effects. Visa, Airbnb. The company itself doesn't produce much. It provides infrastructure that third parties use, and the value grows as more people join. Visa has a market cap of $612 billion and doesn't issue a single credit card. Airbnb sits at $80 billion and doesn't own a single hotel room. The third is the infrastructure monopoly. Waste management, valued at $90 billion. Equinix, pulling $9.2 billion in annual revenue. Asset-heavy businesses in regulated industries with multi-decade contracts and enormous switching costs. Once built, they print cash on autopilot. The fourth is the private equity roll-up. Constellation Software. Companies like Apex Service Partners in HVAC and plumbing. They consolidate fragmented industries by buying up hundreds of small operators and running them under a shared back office. Executives source deals. Local branches run themselves. 4 archetypes. On the surface, they look completely different. One sells insurance and candy. One processes payments. One runs landfills. One buys accounting software. But they all share one singular architectural trait. They all decouple capital allocation from daily operations. The executive layer doesn't manage the product, doesn't talk to customers, doesn't deal with hiring. It manages capital. It designs incentives. It enforces financial discipline. Everything else happens somewhere else, inside autonomous units run by highly motivated local operators. That's the reframe. Self-operating businesses are not automated. They're delegated. They're structurally decentralized in a way that most founders are psychologically incapable of tolerating. Let's look at 3 real case studies. Each one reveals something deeper about how this actually works. Case Study 1. Berkshire Hathaway. Warren Buffett and Charlie Munger designed Berkshire not as a company, but as an internal capital market. One explicit decision drives everything else. They decoupled capital allocation from operations. Buffett called it delegation to the point of abdication. Here's what that means in practice. Subsidiary CEOs have absolute autonomy, full control over hiring, firing, pricing, strategy, marketing. Buffett doesn't visit, doesn't review quarterly plans, doesn't second-guess product decisions. The only requirement is that excess cash gets swept up to Omaha. What happens with that cash is his department. What happens inside the business is yours. The numbers are staggering. In 2025, Berkshire generated $411 billion in revenue and $44.5 billion in operating earnings. By April 2026, market cap sits at $1.03 trillion. Total employees across the empire, 387,800. Corporate headquarters, headcount, 25. Stop and absorb that ratio. $1 trillion of enterprise value. 25 people at HQ. That's not a company. That's a capital allocation machine with a reading room. The mistake most retail investors make is thinking Buffett's edge is stock picking. It isn't. The real engine is the autonomy of the subsidiaries, which produce massive, predictable free cash flow that he then redeploys with almost zero bureaucratic drag. The stock picks are the byproduct, not the business. Case Study 2. Costco. Founders James Sinegal and Jeffrey Brotman made a decision that looked crazy in retail. They capped their own profit margins. Costco never marks a product up more than 14 or 15%. Every competitor is trying to squeeze gross margin. Costco refuses. The reason is structural. Costco isn't actually a retailer. It's a subscription business running a logistics network at break-even to drive membership renewals. The product you pay for is the membership card. The warehouses are how they justify it. That structural choice unlocks something remarkable. It lets them run with extreme SKU discipline. A typical Walmart marketplace carries about 420 million product listings. Amazon carries roughly 620 million. Costco carries about 4,000. 4,000. That constraint is the whole game. 4,000 SKUs means no giant merchandising bureaucracy. No predictive algorithms managing a million variations. No complex vendor negotiations. A lean corporate team can run a global operation because the operation is simple on purpose. The financials. In 2025, Costco did $275.2 billion in global revenue with $8.1 billion in net income. By late 2025, it was valued at roughly $443 billion. It employs about 304,000 people, and it does all that with a fraction of the operational complexity its competitors carry. The public looks at Costco and sees a big box discount store. Structurally, it's something else entirely. It's a subscription company wearing the costume of a retailer. The operational simplicity is not an accident. It's a deliberate architectural choice that eliminates the administrative bloat every other big box chain is drowning in. Case Study 3. Constellation Software. This one is the most instructive because the founder still runs it, and yet it's possibly the most decentralized of the three. Mark Leonard built Constellation on a simple observation. Niche business-to-business software is extremely sticky. Customers don't switch. Revenue is recurring. Margins are high. But the markets are too small for venture capital to bother with. So he decided to acquire, not build. The mechanism is extreme delegation. Constellation is split into autonomous operating groups that each run their own acquisition pipelines. Leonard doesn't approve most deals personally. He sets the hurdle rate. Big deals have to clear 20%, smaller ones 30%. If the math clears, the local team executes. After acquisition, the founders and managers of the acquired company usually stay in place. They keep running the business. They just get a capital partner who never interferes and long-term incentives tied to return on invested capital. In 2025, Constellation did $11.62 billion in revenue with $512 million in net income attributable to common shareholders. Market cap as of April 2026, $38.7 billion. Employees, approximately 69,000. In the fourth quarter of 2025 alone, they deployed $571 million across a swarm of individual acquisitions. Think about the math of that. $571 million in one quarter across many small deals with a tiny central team. That's physically impossible if headquarters needs to integrate anything or oversee operations. The only way it works is if the local operators are running the businesses and the central team is just moving capital. And here's the misconception. People assume private equity creates value by cutting costs, firing people, consolidating sales teams. Constellation does the opposite. They create value by providing permanent capital, sharing best practices across the portfolio, and getting out of the way. The local operator keeps their job. They just get a patient backer and a set of financial targets. Now, here's where this gets uncomfortable. Because the story I just told you has a darker side. And if you skip this part, you'll fall for the myth. The myth is that a self-operating business means you don't work. That the founder spends 40 hours a week reading, like Buffett famously does, while money flows in. For the founder at the apex, after decades of building, that's roughly true. But the labor didn't vanish. It got relocated. In a private equity roll-up like Apex Service Partners, the board level looks serene. The HVAC and plumbing operations underneath do not. The grueling work of installing new enterprise software, managing labor shortages, standardizing pricing, and executing route density strategies still has to happen. It's just being done by acquired founders and installed general managers who are heavily incentivized to grind through it. The labor got delegated to highly motivated professionals who own a piece of the outcome. And there's a harsher reality underneath. The vast majority of founders who dream of a business that runs itself never get there. According to the Exit Planning Institute, 70% of small businesses that go to market fail to sell. Data from BizBuySell shows a median close rate of only 6.46% between 2018 and 2022. Why do most of them fail to sell? Founder dependency. The revenue engine walks out the door the moment the founder leaves. The relationships are in their head. The pricing logic is in their gut. The key customers call their cell phone. Institutional buyers take one look at that and walk away. You don't have a business. You have a job that happens to generate invoices. This is the hidden lesson behind every billion-dollar compounder. The work doesn't go away. It gets engineered into a system early, on purpose, by a founder who accepted that they had to stop being the best operator in the building if the building was ever going to outlive them. So how does it actually get built? There are 8 principles that appear across every archetype we've discussed. 1. The free cash flow mandate. Self-operating businesses do not chase unprofitable top-line growth. They optimize for recurring, high-margin free cash flow. Constellation generated $1.68 billion in free cash flow to shareholders in 2025. That's the fuel. Without it, the whole machine stops. 2. Extreme decentralization. Headquarters dictates the what. Operators decide the how. Berkshire runs 387,800 people from a 25-person office because HQ literally doesn't have opinions on pricing or hiring. When Henry Ford's first automobile company collapsed, it was because he refused to decentralize. He tried to micromanage everything and drove the company into insolvency. 3. The alignment matrix. Replace direct supervision with mathematical incentives. When a regional manager's bonus is tied directly to the free cash flow they generate, you don't need to monitor them. The incentive does the monitoring. 4. The unsexy premium. Self-operating compounders live in boring industries: waste disposal, insurance, vertical market software, landfills. Boring industries attract less venture competition, face fewer disruptive shifts, and reward the operator who shows up for 30 years. Waste management pulls $25 billion in trailing revenue without constantly fighting off startup disruptors. 5. Knowledge systemization. Tacit knowledge in the founder's head is a liability. It has to get extracted, documented, and embedded into standard operating procedures. Danaher built a codified framework called the Danaher Business System, and they force every acquired company to adopt it. The system produces the results, not the individual genius. 6. Thorndike capital allocation. The most effective CEOs redefine their own job. They stop being chief operators. They become chief investors. Their entire day is deploying cash to maximize per-share value. Everything else is a subordinate's job. 7. Contractual moats. Lock customers in structurally, so the business doesn't constantly acquire new ones. Once a corporation migrates their data center to Equinix, the switching costs are so high that revenue becomes permanent. Standard consulting firms don't have this. Every month, their revenue resets to zero. 8. Constraint as leverage. Limit the surface area. Costco does $275 billion in revenue with 4,000 SKUs, not because they can't carry more, but because carrying more would break the system. Saying no to breadth lets you scale in depth with a fraction of the management overhead. Those 8 principles are the blueprint. Not a mindset, not a productivity hack, structural engineering. And here's the part that should land hardest. Most founders never execute on this because it requires a psychological shift they're not willing to make. It requires admitting that the business has to outgrow you, that your best people should be making decisions you disagree with, that the system needs to be good enough to survive your absence. There is a concept from Gino Wickman's entrepreneurial operating system that names this directly: the visionary and the integrator. The visionary is usually the founder. Big ideas, long-term vision, high-level relationships. The integrator is usually a chief operating officer or a president. They run the profit and loss. They hold the team accountable. They execute the rhythm of the business. A business that runs itself requires both. A founder who refuses to hire an integrator is signing up to be trapped forever. A founder who hires one and then micromanages them has just built an expensive middle manager. The math of this shows up at the exit. Main Street HVAC businesses, the kind a solo operator builds, sell for 2.7 times earnings. When those same businesses get consolidated into a platform with 3 million plus in EBITDA, the multiple jumps to 7 times. Fully systemized, institutional-grade platforms exit at 17 times or higher. In early 2025, Goldman Sachs acquired Sela Services for roughly $1.5 to $1.7 billion, at a reported 17 times EBITDA. The same cash flow. Valued at 6 times more because the business no longer depends on any one person. That multiple expansion is the prize. And the path to it is not harder work. It's different work. The work of building systems instead of outcomes. So let's zoom out. The story we tell ourselves about billion-dollar businesses is that they're built by extraordinary people who grind harder than the rest of us. And sometimes that's true in the early years. But the businesses that actually compound, the ones that outlive their founders and generate wealth for generations, share something most people miss. They were designed to be separable from the person who started them. The founder built a system first and a product second. Most founders never make that shift. They stay the best salesperson, the best operator, the last decision maker in every meeting. They call it leadership. The market calls it founder dependency. And when they try to sell, the market discounts the business by 70% or walks away entirely. The ones who make the shift accept something uncomfortable early, that the goal is not to be indispensable. The goal is to be optional, that their role is not to run the business. Their role is to build the engine that runs the business, then step back and let it run. Real wealth, the kind that survives retirement and funds grandchildren, lives on the other side of that decision. The ability to be absent, the ability to walk away, the ability to own something that keeps producing whether or not you show up tomorrow. The guru selling you passive income is usually selling you a better job. The compounders building quietly in industries you'd never notice are building something else. Freedom engineered into the architecture. Wealth that doesn't need you. So here's the question. If you're running or building or thinking about starting a business, are you designing something that will run itself one day? Or are you just designing yourself a job you can't quit?